Hello, and welcome to this podcast from the Private Wealth team at Saffery. My name is Leonora Stevens, and I'm a partner of the Private Wealth team based in Bristol. I'm joined virtually by Mike Hodges, a fellow Private Wealth partner based in our Manchester office. Hello, Mike.
Hello, Leo.
Today, we're discussing a topic that seems to keep cropping up in discussions at the moment. We're going to be talking about employee ownership trusts, known as EOTs, what they are and why people are using them, plus the tax benefits of using an EOT. As always, I like to start with the why, i.e. the hook, to make sure you continue to listen to this podcast. Why would you be interested in an EOT? Well, if you're a business owner thinking about exiting, you can transfer controlling interest in your business to an employee ownership trust without paying capital gains tax. It can be hugely beneficial for entrepreneurs looking to exit, with the benefit of not having to pay any CGT. So this is increasingly important following the sort of reduction of the benefits of business asset disposal relief going forward. So what is an EOT? Mike, would you like to cover off the basics of what is an EOT? What sort of scenarios would you have seen them being put into use?
Yes. It's a trust, but don't let that scare you off. When you hear them being lauded for the benefits, the cliche example is John Lewis. And I checked before we started this recording. John Lewis goes back to 1929, so nearly 100 years. That's the model that everyone points to as the sort of paradigm. This is what you're trying to achieve. And I was saying to you, this is showing my vintage, mid-1990s, there was a rush of employee benefit trusts, which is similar to but different from, because I suppose you'd say an EOT is a subset of an EOT. Been around since about 2014. It's a statutory creation, as I say, to try to get more businesses to model what the good things about the John Lewis partnership have been. Between mid-90s and then, so the 20 odd years with employee benefit trusts, was a bit up and down because people got too greedy. They became quite controversial, hit the press in our world. So Rangers Football Club had an employee benefit trust, and they were used for what was seen as abusive purposes. So we'll come on to some of the rules about how these things work, how EOTs work, because the tax man has put some rules in to stop them being abused. But they are, for the right kind of business, very powerful. You've talked about the benefits of someone selling a controlling stake in their company to an EOT, but you're looking to engage your employees, your workforce. So for the right kind of people business, they can be very powerful indeed. And I drive past Richer Sounds if I'm on the way into the office, and that's owned by an EOT. Julian Richer transferred his business in. In my personal emails, I get updates from a local restaurant and delicatessen business, and they've just transferred their business to an EOT. So it's one of those things that's growing. It took off quite slowly. I think from the statistics I saw to the end of 2024, there are something like 2,000 of these creations around the place. So not a huge number, but significant enough. And I've also seen a statistic that says that 5% of company sales are now to employee ownership trusts. So they're starting to take off in a way that perhaps they didn't in the early days. So all sorts of different situations and scenarios that come across, and they need some thinking about because they're still a bit novel, but lots of potential benefits.
Now, from a very simplistic point of view, because obviously we don't want people to disengage from listening to the podcast, so to keep it at a high level, in order to set up an EOT, you need to set a qualifying EOT has to be set up. And then what happens is the business owner sells more than 50% of the current share capital to the EOT for market value. The key point on this part is about the valuation of the shares. And I think Mike will come on to sort of the risk areas on the valuation in due course, but you need a proper valuation at that point of the shares. And then part of the purchase price may be left outstanding as a debt owed by the EOT to the selling shareholder. Then what happens going forward is that the company uses future profits that it's generating to make a contribution to the EOT, and then the EOT uses those funds to repay the outstanding purchase price. So it sounds relatively simple, but obviously these things never are. Mike, where are the pitfalls, in that sort of basic framework?
I suppose pitfalls are if you are let's start with the seller to start with. The EOT day one, as you've described, Leo, it's set up. It's just a bunch of legal documents, so it doesn't have any cash. Bankers I've spoken to, I don't think they're necessarily quite up to speed. There's probably a banker listening now saying, I am, we are. I think I've met one who said, yes, we would fund an EOT. But normally, as you said, you're in the position of selling your business, possibly for some upfront cash, which may be in your company already, but then IOUs, loan notes. So the company has to continue to be profitable for you to get the value of those IOUs paid to you. So you've got to think about how long that's going to take, the structuring issues, the risk issues, because I don't think we've said so far, there was some tightening up done in the budget at the end of October last year. And I think one of the potential abuses that was spotted and has been stopped is I sell my company or controlling stake in my company to an EOT. I'm then the trustee, and actually nothing's much changed. I'm still in control. You're not allowed to do that anymore. So you are having to think about the future of the business and how you're going to get but being blunt about it, how you're going to get your deferred consideration, your loan notes out. So I think that's the key. From the employee's point of view, I guess, there's some commentary that says, well, does it really provide that much of a benefit? Yes, you've got the right ethos, but is it more theoretical than practical? Because what you are allowed to do is pay an amount each year, £3,600 a year tax-free to employees maximum. But that's not a huge amount. And it's one of these where you have to include everyone on pretty much the same footing, as a very similar basis. And then one of the downsides is if you're saying longer term, business controlled by EOT, what happens when there's a future sale? Well, the future sale will be subject to capital gains tax on any profit for the period the company's been owned by the EOT. And then if you're paying that pot of money to the workforce, would be income tax as well. So at that level, you start to think, well, that's not really ownership in the same way as the owner we're talking about transferring their business into the EOT, because you've got a double level of taxation. So there has been some pushback on that. So it's possibly still got some way to go to be the perfect tax vehicle on a medium to long term basis. The attractions, the hook, as you said at the start, Leo, is to get people to sell their business into an EOT, and very attractively say it's tax free. But just be wary about, okay, tax free is great, but how long are you waiting to get your money?
I suppose then you look at the who are going to be the trustees of the EOT, and what is, as you say, what is the benefit for the employees? I suppose the employees want to work harder, generate more profit for the company.
I think a lot of it, the John Lewis scenario, and my son worked at Waitrose as a student job for a while, and he did get bonuses. I think recent years they've stopped, haven't they? But there's that kind of sense. Is it all about the money? I don't know. I'm not sure he really thought he felt he owned a part of Waitrose or John Lewis. It's a nice sound, isn't it? And I suppose the sound bites are great, but people might say, well, what's in it for me? I suppose they don't see themselves working very hard and someone creaming off in financial terms the benefits of all their hard work. So you are spreading it out amongst people, and it can't. I know our world's a bit distorted, but it can't all be about the tax, can it? So there are benefits, and I think it is the people businesses that tend to focus on it and see it as a good thing. But I think it's therefore not going to be for everyone.
I suppose it's initially driven by the founder who wants to get out, but knows that it's let's say as we will be ethos and continuing within that business, the EOT provides a platform to incentivize their staff. Where would you see as being one of the key risks of an EOT?
The one that people have focused on a lot is this whole concept of what's my business worth, because there's no such thing. There's no one valuation. And I suppose if someone's saying to a business owner, you can have your proceeds out tax-free, do they get greedy? And if you've got the owner on the one hand and the trust on the other hand and the trustees on the other hand, the owner wants to maximize their value. The trustees, who are representing the employees, mustn't overpay. So the change from the last budget of saying, well, the owner can't swap hats and become the controlling trustee is a sensible one, in terms of it takes away some of that conflict around valuations. But there is a potential tension there. So I suppose some of the work we would do, not you and I, but other partners within Saffery, is around that valuation, to make sure the valuation is right, just so that trustees can't get accused of overpaying and everyone is happy. But interesting. And I know one of our retiring partners was saying in our last meeting that he's off to be an advisor to an EOT, isn't he? So he's going to sit as trustee, and we were going to tap him up for advice when he's had a few months under his belt. So we focused a lot on some of the issues. We're getting a bit negative, Leo. So to lift us, and we're recording this on a Friday afternoon, what are the advantages, positives?
Well, we briefly said the CGT is a key advantage, really. You know, if you're selling your business and you haven't got to pay capital gains tax, that's brilliant. If it's not to an EOT and it were to say an external party, you know, they would pay 10% up to £1 million of gains, which if it qualified for business asset disposal relief and they still had their allowance, with the rest being taxed at 24%. And also following the budget, the business asset disposal relief sort of rates are changing. So it's 10% now on the first million, and then it's going to 14% from the 6th of April 25, and then 18% from the 6th of April 26. So it's basically taking up to the basic rate of capital gains tax. So as you can see, if you were selling for 10 million, that makes quite a big difference from zero to, I probably should have worked out what the gain would be if you did have the 1 million with relief or ladder. So that's a key driver for people. But again, as we said, the timing, you just have to consider when are you going to actually get your money. Another thing is what we would recommend is if people are thinking about this, and you should get clearance from HMRC just to ensure that you get the certainty about the tax treatment on the sale, because you don't want to go through all that planning and then once you submit your tax return, it's withdrawn and you end up having to pay that CGT. Another thing from an advantage point is that the directors can still remain in their job, you know, and they can continue to receive a salary. Just the difference is that they won't control the company anymore. That will be the trustees of the EOT. So that's something from a mindset perspective that people just have to bear in mind. Another advantage is that if you were looking for an external buyer, then you know the costs of sale for you would be potentially significantly more than if you just sell to an EOT. So again, depending on the quantum, that can be sort of relatively minimal, but as I say, transaction costs are less. I think, Mike, we've briefly talked about what the advantages are for employees.
Yes. Yeah.
Other than incentivizing them being part of John Lewis Partnership would be great. Are there any other advantages for the staff?
I think it's that mindset one, isn't it? As I said, it's not all about tax. Suppose they do stand if the whole thing is hugely successful, and we're looking at pound notes again, that there's a payday at the end, but they're not going to control that. That's going to be in the hands of the trustees. The trustees are looking at the whole class of employees. So I don't think it's going to be a case of saying, yeah, you can reckon on scooping your pool. It's not like the lottery where you're going to get your share of it with a winning ticket at the end. But I suppose it's that psychology of it. We're all in this together. We're working together. One of our values as a firm is we're collegiate. It's taking that to the next step. And business owners perhaps putting their money where their mouth is and saying we're happy to allow the business to carry on for the benefit of the whole workforce. I think it's all around that. The tax-free salary bit could be more generous. I've seen someone say, well, had it been indexed from 2014 when they were introduced, it would already be more than £5,000. So 3,600 isn't very generous, is it? So
And have you got any examples of cases where you've had a sale to an EOT for clients, and whether there are any traps you had to watch out for, or positives and negatives?
I think the main trap is, and one of the points we haven't talked about, and we don't want to get too techie in this because it's not the object of the exercise, is it? Is to make sure you get your tax-free treatment. The trust following the budget for the 4 years after the sale has to do the right thing. So it has to continue to qualify. So you are then looking not just at the point of sale, but rolling forward. So you have to build protections in to the deal you do with EOT trustees to make sure that you've done all your planning, it's tax-free, something doesn't happen to unwind that tax benefit, because as I say, it's now a 4-year window. And I think that's just to stop people, or the risk of people. I can't say I've seen a case where it did get abused but it used to be a 12-month window. So it's those sorts of things. They're not as familiar as your mainstream do a corporate transaction, buy a seller unconnected, it's a trade seller, or more and more it's a private equity seller. But it is a real alternative, because you can create your own transaction and in your own shape, and it's a controlling stake. So you can say, right, I'll sell 51% and keep 49%, or 49% sits with other shareholders. It doesn't have to be an all or nothing. It just has to be a controlling stake. So I think it's got attractions. I think it could be slightly more tax friendly. It's heading in that way. There's a lot of protections around it to stop it being abused, which is, I would say right. But for the right situations, we keep saying, then it's good. Quite complicated, not as familiar as a mainstream deal. So you just need to make sure you think about your plan and take the right advice, which I know we hammer home every time we have these conversations, don't we?
Yes. I mean, the one thing we've spoken all about family investment companies. I would emphasize that this doesn't apply to family investment companies. It's trading companies.
This is trading businesses, trading companies. Yes, it's not designed. That would be too good to be true. You create all your value in your family investment company and then sell it tax free. That's not happening anytime soon. And that's that dividing line between wanting to give tax incentives to trading businesses, which is, I would say, is part of the sort of suite of tax incentives that it's healthy to have out there to give people options.
Well, I think, so as a sort of a recap, what's the EOT? It's an employee ownership trust whereby the founder can sell their share, controlling stake, tax-free, and then take the proceeds over a number of years. Got to stick to the rules for at least 4 years to make sure that they still qualify. It's trading. I think depending on the particular scenario, it could be very beneficial. It's not the right answer for everybody. I think some people just say, I want to sell and I'm done with it. I don't want anything else. I don't want to have anything else to do with it. I want the money. For the right person, it's the right answer.
It's there in the mix. I suppose the other thing we haven't said is there's no cap. You talked about BADR, where there's the £1 million lifetime allowance. There's no upper limit on the value you sell at. So the limiting factor will be how much of a price, how much cash you can get out on day one, and how long you're waiting. Because if you have tens of millions of pounds worth of value, and that's all on IOUs that the trustees owe you, you might not be as comfortable leaving that behind to unravel out the future profits of the business. But that's the concept in the way that the rules are drafted. There's no upper limit.
Great. Well, thanks, Mike. Another bite-sized canter through what the EOTs are. So thank you for that. We work with a wide range of clients at Saffery's. Many are UK-based and live overseas, but have interests here, whether that's equity, business interests, or investments. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. If you'd like to find out more about Saffery's and how we can help you, please head over to the Saffery website at www.saffery.com. However, it is important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice based on your individual circumstances. Thank you for listening.